Hello friends, welcome back. This is Renu Srikanth Tantry, back with the fourth session of a quick revision for Term 1 exam. Today we will learn some important concepts related to the topics financial statement and its analysis and accounting ratios. So let's start. First we will take up financial statements of a company and the analysis of financial statement topic. The first question is, which of the following is not a part of finance cost in the statement of profit and loss account? As you know, for a company form of organization under the Companies Act, the formats in which the balance sheet and statement of profit and loss account is given and the information has to be furnished in that particular format. So accordingly, here in the statement of profit and loss account, they are asking which is not a part of finance cost. Now, out of these, if you see, the options are bank charges, interest paid on debentures, interest paid on public deposit, loss on issue of debentures. Finance cost is a cost incurred in raising finance for the business. And here, debentures is a way of raising finance and interest being paid on it is a finance cost. Interest which is paid on public deposit. So from the public deposit accepted and on that interest is being paid. That is also another way of finance and interest paid on it is a finance cost. And as I told you, debentures is a way of raising finance. And when there is a loss on issue of debentures, normally when it has been issued at a discount, at that point of time, we use this account loss on issue of debentures. So it is also part of finance cost. It is A, bank charges is not a part of finance cost because bank charges, although charged by a bank, which might be providing finance, but these charges which are levied are not related directly to the amount of loan that might be taken. It is normally the bank charges are levied on the other services that the bank provides the account holder. And therefore, this would be classified under other expenses, not under finance cost. So, this is the option A, which is a right answer for this question. I hope that is clear. Moving on to the second question. Interest on loans given by a financial company is shown in the statement of profit and loss account as. So, interest on loans which are given by financial company. Now, basically a company, we have to see what type of company it is, whether it's a financial company or non-financial company. Here, financial company means that main business is they accept loans and they provide loans. They accept deposits probably and on that they will pay interest and from that money they will be providing loan to other people. So here interest on loan given by the financial company means a loan here has been given by a financial company. So on that loan given, it would be collecting interest from the person who has borrowed from the financial company. And being a financial company, the main operating activity of the business is borrowing and lending. It would borrow or accept deposits and then it would lend to the people who are in need of the money. So this is the main operating activity and therefore whatever is the interest which is earned by the financial company by lending, that would be from its operating activity and therefore it would be part of revenue from operations. Non-financial company, let me explain it to you. The company which is not in this particular business of borrowing and lending. It can be a manufacturing company which is buying raw material, manufacturing and selling its product. It might be a trading company which is buying, adding its profit and selling. Or it can be a service rendering company. So here you have to be careful to read what type of company it is. And therefore, being a financial company, interest which it gets from the loan it has given is a part of revenue from operations. It is not other income. It is not expense because it is being received by the financial company on the loan it has given. And none of the above is not an option at all here. Therefore, this is the answer related to the question number 2. Option A. Now moving further to question number 3. Which of the following is not an objective of analysis of financial statement? Now financial statement analysis is a very small topic there, and in that they have specified what are the objectives of doing this analysis of financial statement. But here the question is, they have given 4 options and they are asking you which is not an objective. Please be careful while reading. Don't see that it's objective of analysis of financial statement. Then you will find that if the first one itself is an objective, you will tick it off and you will lose a mark. Read the question carefully, and here it is not an objective. So let us read all the 4 options and see which one is not an objective of analysis of financial statement. Option A, to judge the financial health of the firm. Yes, it is an option. Second, to judge the short-term and long-term liquidity portion of the business. Yes, through the analysis, we will know the liquidity and the solvency position of the firm. To judge the reason for change in profitability of the firm. Yes, through the analysis of the different years, we'll be able to know what is a trend and what is a change that has come about in the profitability. Yes, that is also an objective of analysis of financial statement. Last, to judge the variation in the accounting practices of the business followed by different enterprises. No, this is not an objective analysis of financial statement. We are not going about doing the analysis of financial statement to see how the accounting practices of different businesses have changed over time. That is not an objective of analysis of financial statement. And therefore, the right answer for question number 3 would be option D. Moving on to the next question, 4th one. Which of the following is not a limitation of analysis of financial statement? Again, this is not a limitation. So, out of the 4, 3 are limitation, 1 is not a limitation. So, let us see the 4 options. A, window dressing. B, price level changes ignored. 3, subjectivity, and D is intra-firm comparison possible. So, out of this, if you see, window dressing is a limitation that people might forge or fudge the figures in the financial statement so that very good ratios come out when ratios are applied. That is window dressing. So that is a limitation of analysis of financial statement. Second, price level changes are ignored. Yes, the price level changes because of inflation, whatever is the change, that is being ignored. We are just taking the figures of the previous years, comparing it with the other years, and we are doing the analysis. So the price level changes that have taken place, that is not considered when we are doing analysis of financial statement. Subjectivity, yes, it is a matter of subjectivity that when a person is doing analysis of financial statement, he will have his own views and therefore it is subject to bias, and therefore it is not an objective analysis of financial statement. Intra-firm comparison. Intra-firm means within the firm comparison. Possible. Yes, it is possible. When you do analysis of financial statement, you can do comparison of different years, like say past 3 to 5 years of the data of the company can be put side by side and analysis is possible. So that is possible. That is not a limitation. That's actually an advantage of doing analysis of financial statement. And therefore, the right answer for question number 4 would be D, intra-firm comparison possible, which is not a limitation of analysis of financial statement. Moving further, next one. Question number 5. Under which of the following headings or subheadings calls in advance will be presented in the balance sheet of the company as per Schedule 3 of Part 1 of Companies Act of 2013? Under Schedule 3 of the Companies Act, Part 1 gives us the format of balance sheet and Part 2 gives us the format of the profit and loss account. So that format is the form in which the detail has to be furnished by all the companies which are registered under the Companies Act. Now we are supposed to answer here under which heading or subheading the calls in advance will be presented in the balance sheet of a company. Now calls in advance means the company might collect the money related to the share in stages, and when it is collecting, it will make a call, send call letters to the shareholders, and then they have to pay. There is a possibility that still money is not yet been called. Suppose the application money is being collected. The next stage is allotment stage. Next is the first call, and then is the second call, and then the final call. If the money is being collected in these stages, probably if the company has called up till first call stage, then second call is yet to be made. But if a shareholder has money, he might pay this second call and final call money, knowing that he has to pay anyway. He might pay it in advance to the company. Then, having received in advance the money which it has not yet called up, it will have to keep, the company will have to keep it in a separate account called as calls in advance account. Now, therefore, this calls in advance account, under which heading and subheading would it come under the Schedule 3 Part 1 of Companies Act is the question. Basically, this amount would come under the current liabilities under the subheading Other Current Liability. That is the right option. It is not share application money pending allotment, because here the allotment has already taken place. First call has been made. The second and final call is yet to be made. Share application money pending allotment refers to the money which has been collected by the company on issue of shares. Still, the allotment has not been completed. It is pending, and that is why till the allotment is made, the amount is kept in a separate account called as share application money pending allotment. Once allotment is done, it would be transferred into the share capital. Then current liabilities, yes, but it is not a short-term borrowing. It is other current liability. Short-term borrowing is the borrowing which is done for a short period of time, that is, which is repayable within 12 months from the balance sheet date or within the operating cycle, which is not the right answer here. It's of course not a non-current liability. Non-current liabilities are those which are repayable beyond the operating cycle or beyond 12 months from the balance sheet date, and therefore the option is out. The correct answer therefore is option A. Under the current liability, under non-other current liabilities, the calls in advance would be classified. Moving on, next question is question number 6. Match the following. They've given the different expenses like staff welfare expense, interest paid on debentures, discount allowed, fixed asset written off over useful life. Now, you have to match it with other expenses, depreciation, employee benefit expense, finance cost. Out of this, if you see first the staff welfare expenses is a part of employee benefit expense because it is being given to the staff. Interest paid on debentures, as I told you, to raise finance, debentures are issued, and when interest is paid on those, it would be a part of your finance cost. So it is 4th. Then we have the discount allowed, which is an other expense, and the fixed asset written off over useful life is nothing but your depreciation. And therefore, the answer should be A4, A3, B4, C1 and D2. Therefore, if you see, D option is the right answer for this. I hope that is clear. Now moving on. Next question number 7. Now dividend is paid on what is the dividend paid on calculated? Whether it is on the authorized capital, issued capital, subscript that is paid up, or none of these. First thing, authorized capital is a maximum capital which can be raised. It is not necessary that entire authorized capital will be issued. So that is not it. Second is the issued capital. It is that portion of the authorized capital which has been issued to the public for subscription. So it is not necessary that entire issued capital should be also subscribed. Third, subscribed capital that is paid up. Subscribed capital is that portion of the issued capital which has been taken up by the public, and that also which has been paid up, means to the extent the shareholders have paid whatever they have subscribed for. So the correct option here on which dividend would be calculated and paid on would be the subscribed capital that is paid up. On that, dividend would be calculated and paid to the shareholder. None of these is not an option for us. I hope that is clear. Now moving on, we'll do this case-based question. Now here, Rohan Machine Tools Limited registered itself with a capital of rupees 50 lakh divided into equity shares of rupees 100 each. So it is not 50 lakh shares, it is rupees 50 lakh of 100 each. On 1st July 2019, company issued 15,000 equity shares as fully paid to vendors for purchase of machinery. So this is the issue of shares for consideration other than cash, that is for purchase of a machinery. The remaining shares were issued to the public at par out of the total number of shares. What is the total number of shares? 50,000, because the each share value is 100. Therefore, 50,000 shares of rupees 100 each was authorized capital. Out of that, 15,000 has been issued to the vendors of machinery. So rest is 35,000. So 35,000 shares have been issued to the public at par at rupees 100. Till the date of balance sheet date, the company had called up from public 70% of the nominal value. 70% of nominal value is 70% of 100 rupees, that is rupees 70. This amount called was received by the company. Whatever it called, it has received. There is no calls and arrears. The first question is, what will be the value of share capital shown in the balance sheet? So in the balance sheet, when we have to calculate the amount of share capital that is to be shown, that would be shown in the notes to accounts. Under the authorized capital would be 50,000 shares of rupees 100 each, 50 lakh. Issued capital would be the same, 50 lakh. Under the subscribed capital, you have 15,000 equity shares of rupees 100 each, that would come to rupees 15 lakh, and the rest of the 35,000 equity shares have also been issued. They are also of rupees 100 each, but it is only rupees 70 called up and paid up also, because they have said it has been received by the company. So 35,000 into 70 would be the amount in the share capital, that would come to 24,50,000. So when we add this up together, we get 39,50,000. So that would be the amount. So option B, 39,50,000 would be the value share capital to be shown in the balance sheet. Hope that is clear. Moving on, we'll go to the second question on the basis of this. Where will the machinery be shown in the balance sheet? Now here the question is about machinery, which is an asset. So first you know it's an asset. Under asset, you should know there are only two classifications in the balance sheet. One, the non-current asset. The other one is the current asset. Only two classification of assets in the balance sheet of a company. So here machinery is a part of non-current asset. True. But be careful, read all the options. Second, B is, it's a fixed asset. Yes, of course. Under non-current asset, you have fixed assets. True, that is also true. And then intangible assets. Yes, it is a tangible asset. Under fixed asset, you would have sub-classification of tangible assets, intangible assets, tangible assets under development, intangible assets under development. So, you would have, so that is also right, and D is all of the above. So, the right answer for this question would be all of the above. Don't read the first option and answer directly, because as in this case, see, you could get such question where all of the above would be true. So, machinery is classified under non-current asset in fixed asset under the tangible asset category. Moving on to the third question, how many shares were issued to the public? Now we saw that it was registered with authorized capital of 50,000 shares, and we also saw that it issued to the vendor of machinery 15,000 shares. Therefore, rest of the shares, which is 35,000 shares, were issued at par to the public, and therefore issued to the public would be 35,000 shares. Therefore, the right answer would be C, 35,000 shares of rupees 100 each. 70 called up and paid up is the number of shares which were issued to the public. So with that, the case have finished up. Now we'll go to the second topic for discussion today, which is accounting ratios. Now here is a summary. You can take a screenshot of this. This is a summary of the different ratios. This might help you in getting a quick view of the different ratios that you would have learned, and would be very helpful to you in case you get which one of this is not a solvency ratio or which is not a profitability ratio. So if you know these, you would know the other one is not. So now the ratios that we are learning is liquidity ratio, solvency ratio, turnover or activity ratio, profitability ratios. Liquidity ratio. It shows the ability of the business to meet short-term obligation, means whatever is obligation which becomes due in the short-term period, that would be indicated by the liquidity ratio. Solvency ratio will show the ability of the business to meet the long-term obligations. So whatever is becoming due in the long term, whether the company would be able to pay, that we would be able to decide for using the solvency ratio. Turnover ratio, also known as activity ratio, it shows how efficiently business uses its resources, like its inventory, trade receivable, trade payable, working capital are the resources. How effectively, how many times it is able to turn over within a period of a year, that is being learnt here. Here this is in the form of a pure ratio. These are also normally in the form of pure ratio. Here this is normally in times we write. The profitability ratio helps us to measure the profitability of the business. So how profitable it is, what is a gross profit ratio, operating profit ratio, net profit ratio, and return on investment. This is normally in percentage that we calculate. So this is a quick summary of the different ratios. Now we will do some questions on this. So question number 1, which of the following is not an activity ratio? So which one of this is not activity ratio? Inventory turnover ratio, interest coverage ratio, working capital turnover ratio, trade receivable turnover ratio. So basically out of this, if you see, inventory turnover ratio, working capital turnover ratio, and trade receivable turnover ratio are all activity ratio or the turnover ratios. It is interest coverage ratio which is the odd one out here, which is not an activity ratio. It is a solvency ratio. So refer to the chart, it will be very easy. Here see, the interest coverage ratio is a solvency ratio. So option B is the right answer for this. Next question. Current ratio of a company is 3:2. The accountant wants to maintain it at 2:1. So 3:2 means 1.5:1 and he wants it to increase it to 2:1. Following options are available to him. First thing, it can repay the bills payable. Second, it can purchase goods on credit. Third, it can take short-term loans. Now basically, if you say the current ratio, the formula is current asset by current liability. So originally it is 3:2. So suppose we take it as 3 lakh and 2 lakh respectively. They want it to be 2:1, that is 2 lakh and 1 lakh. See. Now they are given this option. Now what should happen here? Actually it is 1.5:1 and 2:1, which means that we want to increase our current ratio. So our intention is to increase the current ratio. How can you increase the current ratio from 1.5:1 to 2:1? It would be necessary that either you would reduce or you can say decrease the current liabilities, or you should increase the current assets. That would help you in improving the ratio. So let us look at here. Here if you see, it can repay bills payable. So when you repay the bills payable, what happens? Bills payable repaid would lead to one, current liability in the form of bills payable would be paid off, so it would decrease. So our current liability is decreasing. At the same time, your money in the form of cash or bank, being paid off would also reduce. Now let us take amount. Say suppose 1 lakh of bills payable is being repaid. Then what happens? Your existing current ratio is 3 lakh to 2 lakh for 3:2 ratio. So if you reduce it, 3 lakh Of current asset, 1 lakh gone out because of reduction in the cash and cash equivalent in the form of cash or bank balance being reduced, and the 2 lakh of current liability reduced by 1 lakh because bills payable is paid off, gives you 2 lakh and 1 lakh, and you get 2 is to 1. So this is the right answer. It can repay bills payable. Now going further, it can purchase goods on credit. Now if it goes to purchase on credit, what happens in the second option? The stock would increase, which means current asset is increasing. At the same time, the creditors are going to increase, leading to current liability increasing. But we already have deciphered that to increase the current ratio, there should be decrease in current liability. So here there is an increase in current liability. So this will not give us the required result of increasing the current ratio. Third, it can take short-term loans. Again, the short-term loans, the cash and cash equivalents would increase, therefore current asset is going to increase. But your short-term loan increasing, that would increase your current liability. But again, here current liability is increasing. We want a decrease in current liability, which is not happening here. And therefore, that is also not an option. Therefore, we find that it is only by repaying the bills payable that it is possible, and therefore answer A is the right option for you here. Hope that is clear. Now moving on, we go to the next question. The dash ratios provide information about the business ability to pay off debts in the long run. Now long run means ability to pay off whatever becomes due in the long run. Basically whatever related to debts, we have the liquidity ratio and the solvency ratio. Activity ratios are related to your resources being used efficiently. Profitability ratio shows the profitability of the business. So those two are eliminated. So we have liquidity ratio and solvency ratio. Now liquidity ratio means in the short term whatever becomes due. So that gets eliminated. So what we are left with is a solvency ratio. Solvency ratio is basically will give you information about the ability of the business to pay the debts which become due in the long run, whether it will be able to meet its debt in the long run or not. Therefore, the right answer for this question is option C, solvency ratio. Now moving further to the next, pick the odd one out. Out of this, what is the odd one out? We have debt to equity ratio, interest coverage ratio, inventory turnover ratio, proprietary ratio. So out of this, it's very obvious there is one turnover ratio. Rest of them, all of these three are solvency ratios. This C is only turnover or activity ratio. And therefore, the right answer, the odd one out here is option C, which is the inventory turnover ratio. So, hope that is clear. Now, moving on, we'll do a case-based question. Using the information, answer the following questions. Revenue from operation 1,20,000. Cost of revenue from operation 90,000, operating expenses 1,500, inventory 2,000, other current asset 20,000, current liabilities 7,500, paid up share capital 40,000, total debt 25,000. Take a screenshot of this. Now we will solve the questions related to this particular case. First question, what is the operating ratio? So first, you should know what is the formula for calculating operating ratio. Operating ratio formula is cost of revenue from operations plus operating expenses by revenue from operations into 100. Or alternatively, if directly operating cost is given, then you can also take the operating cost by revenue from operations into 100. That is the alternative form. Now looking at this question, here we have the cost of revenue from operation, operating expenses, revenue from operations available. So 90,000 cost of revenue from operation, 1,500 operating expenses, revenue from operation 1,20,000. So cost of revenue from operation 90,000, operating expenses 1,500 and revenue from operation was 1,20,000 into 100. That is 91,500 by 1,20,000 into 100. So we get it as 76.25%. So if you see here, option C would be the right answer. 76.25% is the operating ratio. Now, second question on the same case is the quick ratio is. Now, the formula for quick ratio is quick asset by current liability. So, what is quick asset? You should remember that for quick asset, all we do is from the current assets, we remove two items, namely inventory and the prepaid expenses. So, that will give us quick asset. So, now as per this, let us search for the quick asset detail here. If you see, they have given inventory and they have given other current asset. We know quick asset does not include inventory. So, the numerator for quick asset would be equivalent to 20,000. So, this one, and current liability, the denominator is 7,500. So, write it here, 20,000 divided by 7,500. So, that would give you 2.67 is to 1. Therefore, the right answer is option B. 2.67 is to 1. Third question is, what is debt equity ratio? Now, they have given three options. The debt equity ratio formula is you take the debt divided by equity. Now, what is debt? Debt is related to the long-term borrowings. So, now here if you look here, they are given total debt 25,000. And equity, here if you see from the information, we have paid up share capital, nothing else. Equity would include the share capital and the reserves and surplus. Those belong to the shareholder. If here only this is given, so it would be 25,000 divided by 40,000. So it would come to 0.625. So if you look at here, the option, it is not available. So probably it is 0.63 is to 1, which is the closest. 25 has been rounded off to 0.63 is to 1. So option A is the right answer for this. Next, we have what is working capital turnover ratio. The formula for working capital turnover ratio is revenue from operations by working capital. Now, the revenue from operations is how much? Here, if you see, the revenue from operations is 1,20,000. For working capital, we have to know the formula, which is current asset minus current liability. And if you see, the current asset would include inventory. So it would be 2,000 of inventory and other current asset of 20,000. So total current asset would be 22,000. Current liability is available as 7,500. So using this, we will do the calculation there. So the revenue from operation is 1,20,000 and the working capital is current asset minus current liability, where current asset was inventory plus other current assets, which was I think it was 2,000 plus 22,000. So 2,000 plus 22. Plus 20,000 was other current asset. So it would be 22,000. So 22,000 minus the current liability was 7,500. That would give us a working capital of 14,500. So we'll write it here, 14,500. When you cancel it out and calculate, it would come to 8.28. Don't forget to write 2.828 times. So the right answer would be option C, 8.28 times. So that is how you calculate working capital turnover ratio. Now we will go into assertion and reasoning type of question. In the following question, a statement of assertion was followed by a statement of reason. Mark the correct option. Option A, if both assertion and reason are true and reason is a correct explanation of the assertion. Option B, if both assertion and reason are true and reason is not the correct explanation of the assertion. C. Assertion A is true but reason is false. And D. Assertion A is false but reason is true. So first question we'll take up is where the assertion's liquid ratio reveals the strength of liquidity of the business. Yes, liquidity ratio is related to liquidity of the business. So here the assertion is true. Reason. Let us look at the reason. Liquid ratio is one of the various ratios used to measure the ability of a company to meet its long-term debt, which is wrong. It is to measure the short-term ability of the business to pay its debt in the short term. And therefore, this is false. Reason is false. So if you see out of this, it is option C. Therefore, the right answer here is option C, where the assertion is true but the reason is false. Then moving over to the next assertion and reason. Assertion here is higher is a gross profit ratio is good for the business and lower the ratio, it's not good for the business. Yes, because gross profit is calculated using your operating activity and then all the non-operating expenses and indirect expenses are subtracted to arrive at the net profit. So if you have higher gross profit, it would be good because it would be having a sufficient profit to cover up all your other expenses of the business, the indirect expense and the non-operating expense of the business. But the lower the ratio, you have lesser profit to cover up all the other expenses. So assertion here is true. Now reason is it reflects the efficiency of the operation of the business. A high gross profit ratio indicates that organization is able to produce at a relatively lower cost. Yes, because it is having higher gross profit means its direct activities, what was involved in, it is able to operate efficiently. Sorry. And therefore, that is also true. So, assertion is true, reason is true, and of course, if you see, the reason is a correct explanation of the assertion. Therefore, here the answer is option A, where both assertion and reason are true. It actually helps you to meet, if you have good gross profit, it will be sufficient to meet all the expenses and also would help you to build up reserves. Then we go to the third assertion. Reason question. Assertion is all contingent liabilities are shown in the non-current liability section of the balance sheet. This is not right. Contingent liabilities means what? The liabilities which you think might be incurred in case of an event occurring or non-occurring. Like an example, if a case is pending against a company, then it is possible if the case goes against the company will have to pay, or if it goes in its favor, it will not have to pay. So that is a contingent liability. Here, the liability arising depends upon uncertain event of the case being decided in the court. And therefore, such contingent liabilities are not part of the balance sheet. It does not come into the balance sheet, but it is disclosed as footnote to the balance sheet. It is only disclosed that such a liability does exist and there is a possibility of the case going in favor or against the company. So that's a contingent liability. So this is false. It does not come in the balance sheet at all. It's not under non-current liability. The reason. A contingent liability refers to a claim which is uncertain. Yes, it's uncertain, depends upon the final decision to arise, which may or may not arise, which is dependent on happening of a future event. If the case goes against the company, then the liability would arise. And that going against is uncertain still. So that is contingent liability. Yes, that is true. So this is a case where your assertion is false, but reason is true. So if you see, the option D provides you with this, where assertion is false and the reason is true. So this is the right answer. So this is how you will have to prepare yourself for the exam. So friends, I hope the concepts we discussed today through these MCQs are very clear to you. If you found this video helpful, please do like, share and subscribe to my channel, and please do leave your valuable comments in the comment section below. Wishing you all the very best for your exams. Thank you.